Hi, this is Randy Finney with Right Side of the Chart, and today is Monday, June 6, 2016. In this video, I wanted to do an overview of the U.S. equity markets, but really focus on the Russell 2000. I've struggled lately to highlight or really point out any relevant developments in the markets. There just hasn't been much. They've been resilient lately, I'll give them that, but as far as any bullish or bearish technical events, there's not a lot out there. As I pointed out recently, the most significant development, if you will, or thing to watch, I should say, on the broad markets are these downtrend lines. This is the S&P 500. This downtrend line comes off the highs back all the way back in May of 2015. So it's been over a year now that the S&P peaked. The S&P, as I mentioned, has been clearly in a downtrend, making a series of lower highs, as this downtrend shows us here, and lower lows. That is a downtrend. So be bull or bear, whatever you want, whether the market's going to go to new highs, whether it's going to take out those lows, that's yet to be seen. But one thing is certain is that the market has now been in a downtrend for over a year. And that downtrend is being called into question here, because you have this previous reaction high, you have these other reaction highs, and we're only less than 2%. I think it's about a percent or so above from taking out those previous highs. So let's see what happens. But I did want to point out that's where we're at. The market's about to close here. We're about 15 minutes from the close. No matter what happens today, even if we close a couple points, the S&P being a 2100 point index, point or two is not considered a breakout. When you see a breakout, what I like to see is, number one, impulsive price action first and foremost, not a wimpy, move through there and a close right on or right above the trend line. You want to see a big green candlestick surge on through there. You want to see it confirm with volume. Last time I checked, the S&P was tracking like half. I think it was 50% the average volume. So I would absolutely not consider this a breakout today. Even if we close a point or two above that line, you can always play around with these trend lines, move them this way or that. Again, you want to see an impulsive move through, and then there's the highs. Now, more importantly, what do we have on the S&P 500? This is what I've mentioned on the front page recently, are these divergences. I put a lot of weighting into divergences, as most of you know. Divergences are just simply a way, these are momentum indicators, especially the MACD is a momentum indicator. You have a price indicator here, an oscillator on the RSI. But these, what they do is they warn of impending trend changes. So when the momentum slows, you have prices right now, as of today, they've at least made an equal high from that previous reaction high, maybe even looks like a slightly higher high if I draw that trend line. That is negative divergence. Now, in my book, I don't know if this is written in any textbooks, but I always refer to potential or confirmed divergence. By confirmed, I'm referring to the MACD. I like to see the signal line cross over the MACD line, or these two lines cross. So in this case, when that blue line crosses down below the white line, gives us a bearish crossover. That would take prices reversing and moving back down to do that. At that point, I will say that's confirmed divergence. So that's what I'm on the lookout for. I'm waiting to see these divergences confirmed via a bearish crossover. Oops, I did that wrong. A bearish crossover on the MACD. That may or may not happen. If it does, and I want to see the RSI roll back over and start moving lower, confirming this divergence, as well as prices rolling over. So now we have a divergent high. I'll talk on that in a second, show you the history. I don't have it drawn on this chart, but for those of you who followed me for a while, I put a lot of weighting into those divergences. Nothing in trading is 100% effective, but when divergences used properly, identified properly, and used in conjunction with things such as trendline breaks, breaks of horizontal support, chart pattern breakdowns or breakouts, it really helps to stack the odds in your favor that you'll have a lasting move, especially on the daily time frame. When you have these multi-month divergences, those are good for reversals, trend reversals that last for weeks, if not months or more. All right, let's move on. Look at the NASDAQ. This is the NDX and NASDAQ 100, also struggling with downtrend line resistance. Again, looks like we're going to close right on there today, give or take. So still some work to be done. As with the S&P 500, you have potential divergence. You can see the MACD starting to curl over. That's not yet confirmed. Now, I will say to have this, even if the MACD rolls over here, you have to see the NASDAQ 100 make at least an equal high. So we need to come up to this downtrend line or this horizontal level around 45.78 or so, or even go slightly above there. But if you're bullish and looking for new highs, what you want to see are these divergences taken out. By taken out, I mean the RSI comes up above this level here, the previous reaction high. Also, you want to see that on the MACD. So once you have prices making, or the indicators or oscillators making a higher high along with prices, you've now burned through those divergences. So that hasn't happened yet, and my expectation still we have, even if the NASDAQ 100 gets up, takes out that previous reaction high, you have what I call the New Year's gap. That's this big gap right here that kicked off the selling. And we had this trading range in late 2015, and when that trading prices gapped down and back tested the bottom of that trading range, that kicked off that big selling. That is a very technically significant gap. I've been mentioning it. I mentioned it back here. That's where we failed before trying to get through there. So even if we take out this downtrend line, which we've only had 1, 2, 3, now 4 reactions. We've had reactions here because we've struggled on it the last few days. We didn't have much of a pullback. I define a reaction as either a pullback or bounce off support or resistance and or a consolidation. In other words, we hit that level, we ran up to it, rocketed right up to it, and then stopped cold. And as you can see, we traded for about a week there trying to get through that level. So that's certainly a reaction, and one or two things will happen. We'll either very soon break above it, probably punch up if we do up to this level, or move back down. So again, those are just levels I'm watching right now. Let's take a look at the Wilshire 5000. The Wilshire 5000 is what I would consider the most representative index out there. You have nearly 5,000 companies in the Wilshire, and this is a chart I've shared for quite a bit over the last few years on the site. I'll scroll up so you can see this is a 20-something year span down here. So it encompasses the last 3 bull and last 2 bear markets. So you have a bull market here, and as I showed in this chart before, the similarities are pretty striking. You have well-defined uptrend lines. You have divergence leading up to those highs. This is the RSI up top. So you have a divergent high. In other words, prices making higher highs, negative divergence on the PPO. I use the PPO in lieu of the MACD on the weekly time frames. Divergent top there. You can see it all. And then a breakdown and a pretty impulsive move lower. Now, this I've maintained for quite some time now, even before the market peaked, that I thought this time around would be a little bit different from the previous 2 bear markets. And what I mean by that is we had a financial meltdown here. The market topped in 2007. Took a little while for the crap to really hit the fan, but then we had the meltdown in 2008. So there was a global financial meltdown. Here we had the tech bubble bursting. Most of you remember that. If not, you've probably heard about it. So you had a lot of companies with insane valuations, and we had a bubble like none other, at least not in recent history. Now this time around, things are a little bit different. They've put some checks and balances in the financial system and the banking system they didn't have back then. You have unprecedented government intervention. So, I don't expect, and at least at this point in time, any meltdown like 2008 type scenario. I expected a slow roll, and so far that's what it's been. If you look closely, you'll see an orange line. I put a parabola there, and that really shows a rounded top. This is like, this market turning. It was a very slow economic recovery. The stock market did well with all the Fed intervention, especially coming out, off a 50-something% correction. But you can just take a look at the slow recovery. It's like a tanker in the ocean. It doesn't make a sharp turn, it makes a slow rounding turn, and that so far has been the case. Now we're getting to the point where each additional tick higher, every point higher, chips away at the bearish case. You have sort of that rounded top. No, I'm not putting that parabola can be redrawn. The lines can be moved. And I just went over the downtrend lines as well in the S&P 500 and NASDAQ. But if you look there, I don't want to see prices come up too much. Another thing that I'm noticing is the strength right now in the indicators and oscillators. If you look at the MACD, or I'm sorry, we're up top. Let's start over here. Here's the RSI. It makes a series of lower lows after the market tops. I mean, it had been moving lower, but once the market dropped, you can see the RSI continuing to move lower, just as it did back here. The market topped, the RSI keeps making lower peaks, goes down to oversold levels. Well, it's a little odd here. We had it moving down, leading up to the highs. That put in the divergence. And again, it mirrored these other divergences in scope, duration, everything. These were about 5.5 to 6 year bull markets. This one was a little on the long side there, around 6 something, almost 7 years. I don't know what the actual number is offhand. But you can see the RSI actually coming up, taking out that previous low. We're already at the 60 level. That doesn't wipe out anything here because price is first and foremost. The markets have still not taken out the highs put in over a year ago now. But you do see down here on the PPO as well. PPO always does a good job of defining trends. When the PPO is above the zero line, this green line here, there's a histogram there, but if you look at where the histogram is flattened out in the center point of this line down here, when the PPO is trading above, you're in bull market territory. And when it's trading below, as it was back here, you're in bear market territory. It's as simple as that, and it's pretty effective. Nothing's 100%. You can see here it tried to back test it. Always wait till the last of the two lines cross. That second line was rejected, kept you in bear market mode, and then told you here the bear market was over, safe to come back and play and get back long and stay long all the way up to this point. 2008 or end of 2007, it crossed back down. Told you get out of the market, stay out to right here after the lows in 2009. This was a little, you can call it a whipsaw signal, but it really wasn't. We had a bear market. If you measure it in the NASDAQ, I believe the NASDAQ composite, I know the small caps, they all exceeded a 20% drop, so they had a bear market. The S&P just managed, and I think the Wilshire just fell shy of that level, maybe right around the 20% mark. So either way, call it a whipsaw signal if you want. I mean, it's not anything you follow. If you wait till this thing comes back over, you've already missed. This is just kind of give you the overall primary trend, help you align your trades. So point being that has been negative for quite a while now, and that second line there is just right about at the zero line, a hair above, but it's a weekly chart, so you really need to see a weekly close. My point again is we're right there on the cusp where every tick higher from this point begins to rapidly erode the longer term bearish case. And of course, as I showed you on the S&P, now the S&P is only one index, but we're only about 1% or so away there. The NASDAQ and the small caps still have more work to do to take out their highs. But that's where we're at, guys. And I've said it for a while now, and it seemed that way where, pretty technical juncture in the market. And it makes sense because we really haven't gone anywhere over the last few months. This market's just been trading and grinding around in a range. It rips up, then it rips down. But overall, I really would like to see us roll over soon to keep that bearish scenario alive and well. And if not, we'll, as soon as the charts firm up, I'll start putting some long side setups on there some more. I just haven't seen any that really stand out. And I wanted to share my overall views on the market right now. Okay, let's wrap this up by talking about the small cap index. That's what I really wanted to cover today. Everything I just went over, depending on how long you've been with the site, it's nothing new. I've shared that Wilshire 5000 monthly chart many times in the past. Recently, I've highlighted the downtrend lines that the markets are struggling with. And now let's look at the small caps. The small caps have really stood out lately. They've been one of the strongest indices over the last couple of months here, or last few weeks at least, I should say. Very powerful. And keep in mind, the Russell 2000 index is a higher beta index when measured against the S&P 500. What that means is when it's going up, it goes up more. When things are going down, it falls more. So it's only natural with the overall strength in the broad market recently that the small caps lead. They don't always do so, but on balance, they tend to go up more when the market is rising, and they tend to fall more when the market's going down. So that's that. Now, all right, let's dig into this chart. First thing before we get to the price action, that's what I wanted to highlight, is I mentioned before about divergences and just how well, especially when confirmed with things such as trendline breaks, support levels, resistance levels, how effective they are. So back here, I'll point out this pattern. The white line, these two white lines define a bearish rising wedge pattern. You can see prices moving up in this bearish rising wedge, and that was confirmed with divergences. That was pointed out at the time. So we hit the highs right here. So those divergences led all the way up into the highs, where you can see the RSI and the MACD making a lower low. What happened at that point? Well, we had a breakdown right here. And typically when prices break down from a bearish rising wedge pattern, one of two things happen. Either they do move down impulsively. In the breakdown, that was confirmed. We had impulsive selling, but all of a sudden it hit the brakes early on. That is not where that pattern measures to. Usually you get either a breakdown, and then shortly after the breakdown, you'll sometimes come in to backtest the wedge at a higher level, then move lower, or that breakdown continues. It's never a straight line down, but usually you have an impulsive move, a counter trend rally, and the thing will play out. And what happened here was odd. Now, this is typical of the market in the last 4 or 5 years. It's been just had a lot of intervention, a lot of odd things happening with the technicals. However, I'm a firm believer in technical analysis. Technical analysis isn't witchcraft. It's not some kind of black magic. It's simply when you're looking at the chart, it's a visual representation of where past buyers and sellers have met, and that's why you have support levels. That's why you'll have sometimes a stock tapping on a level, finally breaks above it like this. This was my target zone, which is a resistance level back here. We broke out, came back tested, finally broke below it, came after we broke down below it, we came back up, failed just shy, failed at it again, and rolled over. So it's simple. These are levels well watched. Oh, there's a big lightning strike just outside my door. Excuse me. So these are levels well watched by traders, and there's reasons that technical analysis works. So what happened here, this breakdown was foiled. And I've seen this before. What happened is the buyer stepped in, whether it was natural, unnatural, whatever happened, the market was walked up to new highs. So the bearish rising wedge breakdown was foiled, if you will, early. It did hit my initial target zone, bounced, and the market went on, or at least the small caps went on to make a new high, and that was the high. That was the end of their bull market right there, because this was a 27% drop after that. That's a bear market. Now, what that does is that undoubtedly led to a lot of short clearing, short covering. When the market, when it looks like a bearish pattern fails, you have a lot of short covering. Okay, might have to stop the video here. Power just went out, and I'm on battery backup power, so I don't think it'll finish this video. I'll continue this shortly. Okay, guys, sorry about that, and sorry about all the distractions. I'm trying to do the video, and we're in the middle of a tropical storm down here in Southwest Florida. This is the lightning capital of the United States. Southwest Florida is so. And I'm right in the middle of a big lightning storm. So, all right, let me try to wrap this up. That's that. So we had that breakdown, push to new highs, which, and again, I've seen this before. That is on face value. It looks bullish right there. Undoubtedly, you have a lot of bulls come clamoring in, saying new highs, because everybody knows in technical analysis, new highs, breakouts to new highs are very bullish on face value, because at that point in time, when you have a breakout to all-time highs or new 52-week highs, every single person holding the security at that point is profitable in the trade. You don't have anybody underwater. Just like 52-week lows or all-time lows means every single person holding the stock on that day that came into the day holding it is underwater. So you have a lot of remorseful sellers, and that's why a 52-week low or an all-time low is bearish. So bullish technical event, but as I often say, fewer things in trading are more bearish than a failed bullish breakout. So this is how this market has been. It's trickery, if you will. So you had the breakdown that was foiled. They blew out the shorts, but to me that opens the door for a huge wave down, and that's what happened. Then you can see the 20-something% drop, nearly 30% bear market in IWM, because they blew out the shorts. I'm sure a lot of shorts threw in the towel. You had a lot of longs that got sucked into buying that new high, and they just, were resentful all the way down and finally capitulated here and threw in the towel, or at least a lot of them. I'm speaking in generalities, of course. So that's that. Now, I'll get to this current price action here and talk on that in a second. Before I do, I wanted to mention the divergences. So as I mentioned here, after that breakdown, what happened is if you were short and if you did cover on that new high, then you were fooled. However, if you noted that the divergence only extended at that point, just because we didn't backtest the wedge, just because we went to new highs, it did not take away that negative divergence. It only extended the divergence, as I pointed out here, with prices going on to make a higher high or a second negative divergence. Likewise, as most of you know, I point out, especially on the daily time frame, bullish divergences. Bullish divergences are where we go long. You can take a look at the archives on the site, go back, and you will see that more than likely we were short going into this divergent low, and I was probably long right here, and I know I was long here. You can see the bullish divergences. That's when you go long, once they're confirmed. And everything else, again, that's just one thing. I look at trendline breaks and other things to go long. Sometimes I'll just grab a divergent low and go long even before the signs of the reversal. That's often what I'll do on some of these moves, especially if we've fallen down to a support level I don't have those shown here. So let's now jump over to another. Well, before we leave there, you can see now what we had here is this bearish rising wedge breakdown, just like we had back here. That breakdown, although it did play out for a pretty decent move, all of a sudden they gunned it to new highs. And what did that do? That only extended so far. Now this could change, but so far that has extended these divergences. So now we have double negative divergence, because at this point right here, we had negative divergence at when this peak in the MACD and that peak in the RSI, and that divergence is now extended to this point if we roll over soon. So the market is now closed. That's where we closed today. Another nice day in the IWM. Let's look at another board here, and this might make a little more sense to you. Okay, a little bit cleaner board. So you can see here, and you might say, well, this doesn't look like that. This is a very steep, small wedge, and that's a very sharp, powerful channel. Actually, let's take a look. So look at the scope and the slant, if you will, or the angle of this wedge and this the subsequent price channel, which, by the way, look how well defined that price channel was. Breakdown, backtest. This is technical analysis right here. This is how it works. Numerous reactions on there. Breakdown, backtest, and then that's when it rolled over. So a little bit steeper slope on these two. However, when you zoom in a little bit and you really take a look at those patterns up close, they look very similar in nature. So you have the rising wedge, you have the breakdown. That could have gone a little more. I think it hit, if I'm not mistaken, my first target. That might have had different targets. I'm trying to remember now. 60-minute time frames. Just different time frames for different trades. However, this is just putting in another divergent high, and you have this nice downtrend line. So this is your next sell signal in the IWM. Let me just wrap up there. If and when we break down, and if and when we do so soon, because we need this divergence in place to confirm this second divergent high right here. In other words, from this peak to this peak. If IWM goes up much more and takes out these previous reaction highs in the MACD and the RSI, which isn't a whole lot higher, then that divergence is now burned through or negated. We also have some pretty substantial resistance here. Just as I mentioned on the Qs, we have a resistance not too far overhead on the Qs. We also have this key reaction high here on IWM. So again, I wanted to point out the similarities between this price action here, that punch up that took out the previous reaction highs. It seemed like an unstoppable rally, and that's the thing, folks. At the tail end of a strong rally, it always seems like the market will go up forever. That's one certainty. The same way when it's doing this, falling sharply, it looks like it's going to drop forever. You just have to almost know that every rally, every correction will end. And where does it end? That's where you use these divergences, not drawn out here. That gives you a sign or an indication to be on the lookout for a potential trend change. What is your sell signal? Again, break this uptrend line here, maybe a bearish engulfing candlestick, a big red candlestick that engulfs these last few days, anything like that. And again, if you're bullish, like I said, as we keep ticking up here and we take out this level, we take out these divergences, we move up. Well, that helps the case for the IWM. You want to look at the Qs, the SPY, the Wilshire, and I name the things that are really will chip away at the bearish case, but we're not there yet. We're really hanging on by a thread here. So, the theme right now, keep it light, stay flexible. If I find any outstanding trade ideas, either long or short, I'll be sure to post those. But for now, I'm keeping the official trade ideas on the light side because of that uncertainty, because we are still at a pretty critical inflection point in the markets where, the charts could change. But as of now, my bias has not changed. I still, longer term, I'm talking months out, remain bearish at this point, although that can change in the next few weeks here, a couple months, depending on what happens. So those are things to look for. And before I wrap this up, one quick look at the trend indicator, and then we'll finish this video. Okay, this is what I call my quad trend layout. I have a short-term, intermediate, a daily, a weekly, monthly time frame. So what we're going to do, the short-term trend indicators have been whippy like crazy lately. We've had a lot of whipsaws on most of the trend indicators, and that's another reason I'm kind of backing off things right now. But this is when you move out to the longer term trend indicators, in other words, a weekly chart or a monthly chart, what happens? Two things happen. Your signals come later than let's say a daily time frame or a 60-minute time frame. You'll have a quicker in. It'll get you in short or long faster on the trend. However, the shorter term trend indicators are much more prone to whipsaw signals. So when you go out to the monthly and weeklies, very rarely do you have whipsaw signals. Here's a 10-year history of IWM on a weekly chart. You can see how that trend indicator kept you short throughout most of the bear market in 2007 to 2009. This, again, as I mentioned, was a bear market in the IWM. I'm just looking at the closing prices here, and that shows about a 24% drop. But when you go from peak to trough, it was I think a 27% or 28% drop in IWM. So that was a bear market. That's not a whipsaw signal. Again, it's not an exact timing indicator. You would have been short at the top, as we were if you looked at trend line breaks, divergences on the daily or 60-minute charts, etc. But this I'm just pointing out here how good of a job this has done, this 1743 EMA pair. That's what we're looking at. I should have clarified. The purple line's a 43 EMA on a weekly chart, 17 EMA. So when the 17 is above the 43, that the histogram down here is green. It's bullish. And this just shows you the distance between the two lines. So what I'm getting at here, right now, we're still on a sell signal, as we have been in the IWM all the way back to early September 2015 when it crossed over. Now, you might say, well, look at this, Randy. Look at the histogram coming up. Look at that moving average come up. For sure, it's going to cross over. It's headed, that green line, the 17 EMA is headed up. The 43 is starting to curl up. So a cross is imminent at this point, and it may be. However, here's why, if you, at least when using this trend indicator, you don't jump the gun. This is one reason. It looked like an imminent cross over here, an imminent bearish cross, but we didn't get it at that point. As you can see here, you zoom in, no green bars. Again, the histogram just shows you the crosses. So what happens is the 43 EMA acts as support when tested from above with the 17 EMA, or resistance when tested from below. So you had another instance right here where it was looked like an imminent bullish crossover on the pair. In fact, this was back in 2008 during the meltdown. So we already had a healthy correction. Everybody thought that the worst was over and it was safe to come back in the water and play. That's not the case. So you can see the lines kissed, and then boom, the biggest selling, the market fell off a cliff right there. So all I'm trying to say is nothing is 100%. But if you're bullish and you want additional confirmation that it's safe to come back and swim in the water, the sharks are gone, then you want to see a weekly close. It's a weekly chart, so what happens intra-week has no significance at all. You want to see a Friday close, and ideally a few green bars. The more green bars you see, especially when they're moving up, then there's a good shot that at least this time frame, this weekly indicator has flipped from bearish to bullish. But right now we're looking at a potential kiss or a back test of the pair, and that aligns with everything I just covered on the broad markets, the SPY or the S&P 500, the NASDAQ, both testing those primary downtrend lines, the pattern that I just showed you in IWM, everything else. And the longer term indicator that I have on IWM, my monthly indicator, I'll wrap the video up here, is still on a bearish trend, bearish sell signal, and has been for a while. And that one couldn't even possibly flip to bullish until the end of this month. So in the possibilities there, as I mentioned, we're at a pretty critical inflection point. So I just wanted to spend a lot of time on the small caps today, because if this market is about to head lower, these small caps have ripped lately, and I think there'll be more meat on the bone for IWM short if you prefer shorting broad market indices versus individual stocks. If you like the broad market ETFs, the IWM, should we turn down soon, probably will fall more so than the SPY and probably even the QQQ. Okay, this has been Randy Finney with Right Side of the Chart. Hope you enjoyed.